Hey, what's up? It's Sean. So today I'm going to talk about paying down your mortgage faster than what it's scheduled for. So for example, if you have 30-year mortgage, is it better to pay extra every month to pay less on the interest and then shorten the payment period, or not so good to do so? The short answer is it's going to be good for some people, but not for everyone. First of all, I'm not a financial advisor. I'm not a CPA. I don't really have much credential to talk about this sort of like a financial part of the home loans. I'm going to just strictly look at the compound effect of the interest that I pay and interest that I gain. And so that's more of sort of like an investor's point of view. So I just want you to talk to your financial advisors and CPAs to verify any of this information that I'm going to share with you. And if you are thinking about like a local, the Portland market investment only in real estate, you can talk to me. Paying off your mortgage fast, before we jump into that, I want you to consider refining to lower your monthly payment and interest payment. For example, if your current loan is somewhere close to 4% that you're paying, this might be one of the best time to refi that loan down to about 3%. On a loan, $400,000 loan, let me actually zoom in a bit. 3% versus 4%. You have existing mortgage of $400,000. You're going to save $80,368.22 in the next 30 years. Now, refinance cost is about $7,000. So if it's a $7,000 to refi, it's going to take 2.6 years to make up the difference. That's on a primary residence. So this is sort of like a different section, but I'll jump into that at maybe later or at another time. So let's say you just refied your mortgage payment to close to 3%, which is going rate. It's a September 25th, 2020. Forever family home. You're super comfortable. You don't want to move. Your kids grow up there. You want to retire there. That's a great home to pay off fast. If you want free of stress. You want to lower your monthly expenses, you're kind of closer to retiring age. And if that's the case, it's a great way to pay that down fast so that you have a lower monthly payment. But if you're not doing any of the active investment on the side, it will be good to pay that down because it's like, let's say 3% is basically going to the lender. You're not gaining the 3%. When you talk about gaining the 3%, that's when you have an asset, investment property. But on primary, you're living there, so living cost is covered, but you're giving the 3% to the lender, meaning you're losing that 3% every year to the lender. So in that case, since you don't have an active investment and you've already invested enough that you're not thinking about putting some future investment, then it would be a good time to pay off really fast. Now let's jump into paying down like 3 ways. First one way is you pay what you're paying right now as you've been paying, and then put extra dollars every month, or that's there's an automatic payment. You can actually set that up if you go to for example, I don't know if every lenders are the same, but there's an easy way to just set up certain amount every month so you don't have to think about it, which is the way I like it. The second way is paying the same monthly payment, but you divide it into every other week, so bi-weekly payment. So let's say if you're paying $2,000 a month, you're paying $1,000 every 2 weeks. So you ended up reducing the interest accruing period, and at the same time you reduce the payment and interest as well. Because of that compound effect, I wrote it down right here. This is basically main topic for today. And then the third way is a bi-weekly, the number 2, and extra payment. So you're going to see the difference. So the first option, if you pay $200 extra on top of your mortgage, and this number is all based on $400,000 loan. I'm going to put the calculator that I found I really liked, and you can plug in your numbers and you can see what your number, savings would be like. Option 1 reduces the 30-year to 25.3 years. If you did the bi-weekly payment, 26.5 years. And then if you did bi-weekly plus extra $200, 30-year loan reduced down to 22.4 years. So you basically saved, I think this is close to like 90 payments are saved because you did this bi-weekly and extra. If you just did bi-weekly, so you get this, or this 1, 2, 3 like that. And then the total interest savings during the loan payment period is like this. The first option, you save $96,125.72. Bi-weekly payment, $71,607.82. And if you did both methods, you save $153,334.14. This is what you're going to save if you did that, and you're going to pay off as fast as about 8 years, almost 8 years. If you raise that up to $300 or $400 extra, it actually goes down to like 18 or 19 years, meaning you save about 11 years of mortgage paying years when you get gray hair. And I think about 90 or 95% of Americans, we invest in stocks or real estate. What if the extra $200 was put into, let's say, like stock market, like S&P 500 in the last 90 years, average appreciation, annual appreciation is 9.8%. And then the properties that I'm looking at right now, it returns about 10.6% in about 30 years, or I did 20 years on that one. So that's annual. If you're doing this, you're going to make more than that 3%. So if you don't have any near-term plans to retire, it might be better to use that extra $200 into investing higher percentage compound effect on one of these. As long as you have the long-term investor's strategy, meaning whether the market goes up or down, you don't panic sell, you don't get sick in your tummy, and you don't lose your sleep because you're a long-term investment, then I think it's better to, in my opinion, invest in either stock or real estate. Now, in the stock market, I don't really know much about stock market. I've been trying to learn about the index funds, S&P 500, and I looked it up. It's like so expensive to buy. And then you can't really, they say don't individual, stock picking, don't do that. And I try to learn that, but it's not something that I'm familiar with. But on the real estate, I've been doing it for about now 12th year. I've seen the downturn, upturn, but I did see what happened during the downtime in 2007, 8, 9, 10, 11. I don't think, well, this is speculation, so I could be completely wrong on this. I don't think in the next 10-year or 20-year future real estate market will get hit as hard as 2008. So assuming that, and the other part is you have enough time to invest in, let's say like 20 to 25 years, you can just invest and you can forget about it. This is the way to go, in my opinion. If you are closer to, I want to retire in the next 5 years, you don't want to do this to minimize the monthly expenses. Now, I'm going to kind of spin off just a little bit. What if you have an investment property? Is it better to pay off that fast? Or is it better to keep it in a low interest rate, lock it in for 30 years and keep renting it out? That, it depends. When you're close to retiring age, you're more of a passive approach of investment. That makes more sense. if you're more aggressive, meaning you have enough time, I don't think I have anything here, but enough time that you're thinking like 20, 25 years of investment, that's more active, more aggressive side. So depending on that, for A, if you want the higher cash flow or full cash flow, meaning the investment property has been paid off and anything that you get from the rent money after the expenses, you're going to net that. If you want the sooner, it makes sense to pay off as soon as you can by aggressively paying down the principal. But if you don't care about that, but you care more about making your portfolio bigger, meaning expanding your investment. So instead of having two investment properties, you want to go aggressive and you want to have like six. And again, that goes down to what your real estate goal is, what your financial goal is. Like, I guess the money that you can use when you retire, is that $5,000 a month, or is it $10,000? Is it $20,000 a month? Depending on that lifestyle that you want to plan for, you can have one property to 10 properties. I mean, if you have a decent 10 properties, that your retirement, I mean, I would think that you will do just fine. If you want to expand the portfolio and be more aggressive, then it's not good to pay that off fast, because you can use that money to somewhere here, either stock market or real estate market. If you want to change your current primary home into an investment, you will need to ask these questions. And obviously, with your current mortgage payment and expenses, tax and insurance, and management fee, all of that needs to be either equal to the rent that you can get, or if you can get positive cash flow, that's what you're looking for. And then on top of that, you need to ask, is your current primary residence a good investment to hold? One of the questions are like, one is, does it rent well? Does it appreciate high enough? Is it a high or low maintenance property? And the other thing is, what type of investor are you? I mean, that's the other question. There's a lot of people young people talking about house hacking. You may want to like a YouTube house hacking. You're going to see like hundreds of videos. What it is basically, let's say you buy a duplex as a primary, you live in one of them and rent out the other one. And as soon as about 2 years that the loan agreement is met, then you can go buy other primary and turn that into investment. And you do that like 10 times, you basically own 11 properties after that, right? So that's called house hacking. I wish I knew that when I was younger. But then I probably would have tried to at least try to house hack, because we live in a small homes before, and I mean, that could have been great. And I could have bought a duplex too, I don't know. But yeah, so house hacking. So that's one thing. I'll probably touch on that in another video, because there's a lot going into it. The other thing that I want to mention is that the opportunity cost. So when I was talking about using that extra, when you're young, when you're active investor, using that extra money into something else that yields more interest, more percentage on assets. So $207,109.81 that you pay in interest. Now that amount is the value that is in 2050, 30 years from now. So when you look at the number, go, wow. But if you consider in the fact that there's inflation, like 2.5%, you put that into this number, that becomes $98,738.09 in today's value. Don't just look at this one, but look at this one as well. And then see what kind of investment plans that you have. If you're active, do something else instead of paying down the mortgage fast. If you're passive, pay that down fast so that you reduce the monthly expenses. So I think I covered most of it. I hope this was helpful. I'm not perfect here. But main principle, I believe I'm pretty, strong in, which is compound effect. Like less percentage on that, you pay less percentage on that, and then gain more percentage of from your asset. So as long as you're giving less, meaning if you have to give 3%, you gotta get back like 6%. Then you're going to be doing better. If it's the opposite, you're in trouble because you're going to lose money, whether you think you might have. But if you're actually giving more percentage to other lenders or, I don't know, credit card company, that's probably the worst. Then you need to change things up. Someday I'll talk to you about my personal, debt that I had, which was a lot of debt, but I'm really lucky to be out of that debt now. But anyways, that I do know that is really important, and it is something that you have to focus on. Anyways, I hope you enjoyed it. If you liked it, give it a thumbs up and subscribe, and I'll see you on the next video. The interest, hey, so one thing I forgot to add is that what happens to that opportunity cost of $200 if you're to invest it into a 9% investment, whether it's the stock market or in the real estate market, what happens, how much do I earn, and what it becomes. So this is basically that. You end up, that 200 extra will basically give you earn, this is not paying the lender, you earn from the stock market or the real estate market, you earn $296,894.81, not including the $200 at the $72,000 of money that you put in. So it's about what, about 4 times, a little bit over 4 times of interest that you gain if you were to use that opportunity cost of $200. And the total becomes $368,894.81. So the future value is going to be bigger than the total interest without doing this extra aggressive payment. That's actually bigger than what you're going to save. And this is obviously inflation not adjusted, unadjusted inflation rate. So paying down the mortgage, you pay that much, but if you pay that and you gain that, I haven't done the math here, but closely like $160,000 that you are going to gain. I might be missing some numbers here, but basically you're going to make at least $100,000 more in the next 30 years because of what? Our friend compound effect. Can you see that, by the way? Yeah. That's it.